Hello, and good morning to everybody who decided to participate in our webinar session once again. It's Thursday, it's 11 o'clock sharp, and we're about to start another episode of The Long and the Short of It by Clive Lambert, Darren Sinden, with a little help from me, your humble servant, Michael Anachov. Before we go any further, let's go through the risk disclaimer once again, because it's very important for all of you to know that trading FX and CFDs using leverage may result in a loss of all your deposit. Trading losses can sometimes exceed all your deposits as well. I'm obligated to say that even though at Admiral Markets UK we have a negative balance protection policy in place, so if your account is ever in the negative, give me an email and I will fix that for you. Today I wanted to talk about our new product, the new era of Admiral Markets trading called Trading 2.0. The timing could not be better either, because Admiral Markets has gone through with the rebranding and the account revolution in October, and by now we know 100% all problems are fixed and the trading conditions are as good as ever. If you go through any website that advises you in choosing the right broker, they'll give you a few tips, something you have to pay your attention to. And those things, those qualities are as follows: regulation, platform, execution type. Well, I'm very happy to let you know that right now Admiral Markets UK is fully FCA regulated and authorized. We give all our traders a choice of 3 platforms: MT4, MT5, and MT4 Supreme Edition, which is our tuned up version of the classic MetaTrader 4. And of course, both of our accounts, Admiral Markets and Admiral Prime, have market execution, no dealing desk, no requotes. As you can see, every box is ticked. So let's enter the shop and have a look around. Let's take that Admiral Markets account because it's going to be our flagship product, the account we're really proud of. Right now, it offers all of you a leverage 1 to 500. Average typical spread is 0.8. No dealing desk, no requotes. And if you're a fan of specifics, just have a look. If you want to trade CFDs on indices, we have DAX, 1 pip spread, Dow Jones, 1 pip spread, and the typical spread on Euro USD is 0.8. Email me if you would like to know more details, and I'll be able to provide you with a full table for your convenience. Now, the best part is, though, that when you open an account with Admiral Markets, you receive a personal account manager. We all know how confusing and frustrating it is when you give your gas company a call, for instance, and it takes you 5 minutes. Well, 5 minutes is very optimistic. It usually takes between 15 and 30 minutes to get through to the operator who can actually deal with your query. With Admiral Markets, you have a personal account manager who is responsible for your trading conditions. So when you email him, give him a call, your query will be on top of his priority list. And I'm very happy to tell you that if you're participating in this webinar, you get the best account manager around. You get myself. I'm great at opening accounts for you. I have a lot of very lovable and humanly quality, so give me an email and on ammo@admiralmarkets.co.uk, and I will gladly help you and hold your hand through your entire way at our company. But right now, I'm going to pass the microphone on the floor to Mr. Clive Lambert, who will take it on from here. Clive?
Thank you very much, Mihail, and having worked with Mihail, can you hear me?
Yes, we
Hello,
can.
Can you hear me? Excellent. Okay, yeah, I was just going to say something nice about you. I haven't worked with you for a few months now. I can say you are a thoroughly nice chap, so you're not just making it up. And now, so I'm just going to press this show my screen thing so I can be the man in charge of what you're seeing. Should be that one there. Okay, so hopefully you've got in front of you chart patterns, continuation patterns. Actually, I've slight error there. We're not talking about candlestick charts at all today for the first time since we've been running this series of webinars. So I've already spotted my first error of the day. Anyway, let's crack on. And what I'm going to talk about today is actually a more sort of Western sort of style of looking at charts. We're not, the candlesticks is very much from from Japan, and before we discovered candlesticks in our part of the world, which is only about in the last 25-30 years, there were other methodologies we were looking at and using in Western analysis, and today I'm going to talk about some continuation patterns. Basically, what do we mean by continuation patterns? Well, it's basically patterns that we regularly see with on the bar charts that suggest that the market is taking a breather, but is likely to continue in the direction it was going once that breather has been taken, if you like. We are going to later on talk about things like head and shoulders and double tops and double bottoms, which are the reversal patterns, but for today I thought it would be interesting, especially we've got a live one on this at the moment, if you like, in Brent Crude, and I'm going to show you those charts later on, in fact in WTI as well. Very interesting stuff. So, I've got this book in my bookshelf. I wish I'd grabbed it now. It's Thomas Bilowski, and it's the Encyclopedia of Chart Patterns. And it basically it's like a 900-page book or something that goes through every pattern you can think of. There's a whole heap of wonderful names for these things. I'm a little bit more of a I just prefer to try and think of what's going on with these, and not worry so much about what they're called, but think about what is actually going on and what that might tell us, basically. So we'll go through a few examples and hopefully give you that idea. So, three types of triangle that we can have a look at and see if we can find on our charts are the symmetrical triangle, an ascending triangle, and a descending triangle. Let me see if have I got, oh no, I haven't. Okay, now, what these are periods of maybe anywhere between, if we're looking at a daily chart, it would be anywhere between 2 weeks and 2 months maybe, where the market literally just takes a pause for breath, okay? And that pause for breath, if it is a symmetrical triangle, we see the market contracting, if you like, and getting tighter, and you can define it with a couple of short-term trend lines that say to you, this market is just having a bit of time off, if you like. Now, if this was seen during a rising trend, then the assumption you make is that we're going to complete that, we're going to eventually break out again and continue to go higher. Sometimes you see the market hitting resistance, but and just taking that pause for breath whilst the lows are still getting higher, and that's called an ascending triangle, which would have this kind of shape to it. In a falling market, we have the market coming down here, and then we're still making lower highs, but we find some support here, if you like, and so that's called a descending triangle. Let's not get, I don't want to get too carried away with with trying to name everything. Just remember, come back to this idea, have a think about the idea of markets don't go up in straight lines, don't go down in straight lines. There are periods where the market takes a pause for breath. See what I did there? I took a little pause for breath myself. I was actually slurping my cup of tea, hope you don't mind. I take a pause for breath during a trend, but generally then continue with that trend. There's a few rules that it's nice to see happening, and that you need to apply to these kind of patterns. For a triangle, you're looking for the volume to decrease through the life of the triangle. We are talking about markets taking a pause for breath, and if that's the case, then quite often the volume does decrease. So you see participants stepping away for that period of time and not really getting involved. But then sometime before the lines meet, preferably about 2/3 to 3/4 of the way from the sort of start, if you like, to the apex here, you get a breakout. Ideally, the breakout occurs with increasing volume. And once you get that breakout, you can say, well, we can measure now where the market may go. The first measuring objective is the height of the pattern, and you take that from the breakout point. I'm going to show you this on the chart in a minute, so just stay with me while we go through this bit. And the second measuring objective is that you assume that, it's sort of recognized that you quite often see these kind of periods of consolidation halfway through a move. Now, if you have identified that you are in one of those periods, if you like, where the market is having a consolidation, and you know that that's halfway through, well, then you can, if we see the breakout again in the direction that we are right, in the same direction as we before the consolidation, then you can say, well, if that's halfway, let's measure to find out where all the way is, if you like. So let's have a look at this. Let's have a look at this in action, if you like. This is Brent crude, and this has been one of the big stories of late. Is this big drop we've seen that topping out in June at 115.71. I was looking back at my analysis the other day, and I noticed that. Well, I wanted to look at what my view was all the way down this move, because I had a feeling I would have been bearish the whole way down, and it was these Marabuzo lines here, here, and here, and I've talked about this before, that was helping us to stay bearish. And sure enough, I turned bearish of Brent crude oil on my daily reports to customers at the beginning of July, and ever since then, almost on a daily basis, we've been saying this is going down, be bearish, stay short, da 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 da, and it's done it beautifully. Now, we got to the middle of October, and suddenly we had there a ascending triangle consolidation, if you like. And then it was the start of November. The 3rd of November was the day that we broke out of that consolidation holding pattern, and we started going lower almost from that moment. Okay, so what we had there was an ascending triangle in a falling market. When we broke the bottom of that triangle, the signal was that we can continue to go lower. And if we do this measuring thing, if we say, well, if the move started up there at 115.66 and then got to 82.93, and then the second leg of this move started when we broke 85.70 on the 3rd of November, what that tells us is that the market can go down to $52, $53. Now, rewind a month ago, I was basically saying to anybody that would listen, that we've just finished a period of consolidation. The market is now set to go lower again, and we could go to $53. Now, I was getting some very strange looks from people. I think a few people were looking at me and thinking, come on, mate, $53. OPEC are going to step in before then, and they'll make sure it doesn't get down there. Well, we all know what happened last week. OPEC had a meeting and decided not to do anything, and that actually gave us that big red candle there, and this has just continued to go relentlessly lower. We did try, and there was an attempt at a recovery on Monday. It was short-lived. We are back posting red candles again, and I've stayed again bearish of this move, bearish of this market, and it's that sort of bigger picture framing of where we could, of having this target down here that is sort of persuading me to stay on the short side with that particular move and stick with the idea that we are heading lower. So hopefully that gives you an idea of sort of these chart patterns in action, if you like. I have prepared slides for this, so let's just sort of go through the rest of those. I think we've done this slide with our rules. There may be a pullback to a broken line after a pattern completes. Actually, let's look at that on the WTI chart. Okay, because the previous chart we were looking at was Brent crude oil, which is the sort of UK benchmark, if you like. the US have their own benchmark for oil. It is called light sweet crude, or CL, is the thing you'll see quite often on things like MT4, and it's actually a slightly different grade of oil. Actually, I mean, Darren might be interested to go through some of these things at some point for one of his fundamental talks. Light sweet crude is a slightly lighter, as the name suggests, grade of oil. It also, the difference between Brent and WTI is all about where it's delivered, and so pipelines and that kind of thing can get into the equation. So they do track each other, but they don't exactly track each other. Some people trade the spread between the two. Anyway, I go off message there. Let's get back to talking about the charts and stuff. Here was a what's known as a, there was more of a triangle there that we were posting at the end of October in WTI, and we broke it on the same day, 3rd of November. And within a couple of days we were a good $5 lower, and look at the way it came back and almost touched that line on the 10th of November. And that was also, there was a Marabouzo line in there. You know, if you listen to my ramblings on the webinars regularly, you'll know all about Marabouzo lines. If you don't, then you need to, you can look it up on my website, and they do a great job. Did a great job on that day, along with the bottom line of the symmetrical triangle, and we sold off again, and then we carried on making lower highs and lower lows. Just remove that for a minute because it might confuse people. Now, actually, I did two measuring techniques on this one. I actually said this move here from the end of September to when the consolidation started could be classed as a shorter term move. So if we project that from where we break out, that gives us a target of 65.05. So it was interesting that that particular target got hit on Monday when we had the volatility on Monday, and we have rallied from there. And we haven't retested Monday's lows yet, but I'm expecting that to happen. But if we take the whole move from the end of June and project that to there, and then from the breakout point, the same measurement down to the breakout point, gives us a target for WTI at 55.78 right down here. So yeah, you can see how that's similar kind of, I've dealt with it in a similar way to the Brent crude, and it's done a nice job for us and has kept us in the trend and kept us away from this very dangerous game of trying to pick bottoms, which many people do. I don't generally. You will not find me very often saying bullish things about a market that's falling. I think I had one time where I think it was the March 2009 low in equities. 4 days beforehand, I went on CNBC and I said, I think this is bottom. I think we're going to find a low soon. I don't know when it's going to be or where it's going to be price-wise, but it does seem to me as if we're, it's just too bearish now. But that was a rare thing for me. I'm actually more than happy to be the guy who is bearish on the day the market bottoms out, because it's only when you see the subsequent price action that you can actually say that was the bottom. And it's a common mistake for people to make, and I think I did, this whole idea of, and let's do it with this chart just to sort of talk you through it. Okay, you could say here, oh, we're seeing some bullish candlesticks, and that might be a bottom, but no, we didn't. We carried on going lower. And then we get to here, and you can say, well, look, that's close to this support level from back here. That's the sort of thing you'd want to be doing, is looking back at old supports, and you think, yeah, okay, that could be a bottom. And there might have been people going out there saying, yeah, that's a bottom for oil. It's got really cheap. It's come down from 102 to 92. That's a big move in a month and a half. Well, it just carried on going, and carried on going, and carried on going. There's our consolidation phase, there's our breakout, and it's still going down, and I am not bullish. and my friends the Marabuza lines have allowed me to stick with that trend pretty much all the way. It's been really nice. So back to the back on message, please, Clive. Let's get back to talking about these chart patterns, shall we? Done that slide. Let's move on. What else we got? Flags. These are quite nice. And you have two different types of flag. You have bull flags and bear flags. A bull flag is a flag is basically a consolidation again, which is counter to the overall trend. But they're defined by two parallel lines, if you like. So we're looking, if your pullback or consolidation period is if you can define it with two parallel lines, then you can call it a flag. This is a bull flag because it's saying the market's going to continue in an upward direction once the consolidation period is finished. And its opposite number in bearish terms is a bear flag. Market's selling off, has a counter trend rally between two parallel lines and then breaks the bottom parallel and continues to go lower. And again, the rules are fairly similar. You want to see the volume thinning out, if you like, as this consolidation period unfolds. They can often be shorter in duration than triangles. You will generally see, hopefully see, an uptick in volume on the breakout. Now, have I got an example of this? There's a bull flag on a stock a few years back, Tesco's, where the market had a sideways consolidation. And again, we can use this measuring technique and say, well, look, if that's where the move started, and that's halfway, then, and this is where the second half, if you like, started, then this is all the way. So there's a potential upside target for you. Also managed to, on this chart, throw in a couple of trend lines to define the move for us as well. That previous slide I just showed you was a daily chart for this period here, and there's our bull flag there, actually. And actually, that was part of a much bigger. Now we've gone to a weekly time frame, and there was a symmetrical triangle in the middle of the bigger picture move, if you like, on that particular example. There are variations on these patterns. There's all sorts of different names we can give these things. One that I often spot is is called a rising wedge, and that's actually where you haven't got parallel lines. They're kind of coming together a little bit, and again, though, this is a falling market, then a consolidation, and then we break the bottom, and off we go. We continue the move. And just that one works out well from a measuring point of view, there to there, strap it onto there, it would say somewhere down here, so that all worked out rather nicely. So these chart patterns are, whatever you want to call them, they're made up of two lines, and the break of one signals that the other is held. That's the way I like to think about these. And so you can sort of, you can get an idea of the trend and any changes in trend from this. And the reason I say this is because I have seen something like this before. I mean, that was the low in Brent crude a few years back. Back on talking about oil again. That was the low in Brent crude a few years back. These slides are slides I've used for donkey's years to teach graduates and stuff like that when I travel around and do training courses. So I won't apologise for them being old, because you have managed to see something that's nice and up to date earlier. Right, so there is a triangle type consolidation. Now, obviously, the problem we had with this one was that if that was halfway through the move, then that was actually going to, and that was oil going from $140 to $40. That means that oil was going to go to minus, oh my goodness, what is it? Minus 120, which I think it's fair to say it can't do. We can't get minus prices on things, and it always looked like there was going to be some buyers stepping in at some point anyway. And that broke to the upside. It wasn't a big surprise to see that period consolidation, and this is actually took a little while longer than most before we broke to the upside. And that was so it was actually a triangle signalling a reversal as opposed to a continuation. And the reason why I point this out, and why the reason for the last few slides being worded as they are, is because when I first started out as a technical analyst, one of the books that everybody recommends you read is John J. Murphy, which is, I think I might have showed you my selfie with him a couple of months ago as well. A very nice gentleman that I was privileged to meet not long ago. And he's got basically the Bible in technical analysis, which is called Technical Analysis of the Financial Markets. Nice and succinct and to the point where book titles are concerned. And that book says that these are consolidation, these are continuation patterns, whereas other books you look at say, well, ascending triangles, descending triangles can be reversals. So I, quite early on in my career, if you like, as a geek who talks about charts to people, was having a bit of a head scratch about all of this and thinking, well, one book's saying one thing, another book's saying another thing. What do we believe? And so I actually came to the conclusion through experience and looking at markets and looking at what goes on that actually it doesn't matter. Let's just put those lines on the chart and wait to see which one breaks first, and that is that it is generally reliable as the direction of travel. They don't work sometimes, so you do get false breakouts. We got caught up in one in the Australian dollar not too long ago. It's called a diamond pattern, and it completely messed us up. It broke in one direction. Okay, here we go. This is what's happening, and then it just went boom straight back and completely got us stopped out on our trade. Don't regret putting that trade on. The chart was telling you to do it. It was a losing trade, but as far as when we look back at the trade, I was more than happy that we did it still. The probabilities were, there you go, Darren, talk about probabilities. That was your subject last time. The probabilities were stacked in favour of a positive resolution for us, but it didn't work out that way, if you like. So just to summarise, talk this chat about chart patterns, and then we'll go on to our charts and have a little look at a few things. Chart patterns are about recurring patterns of behaviour, which is one of our basic tenets of technical analysis. Continuation patterns are generally light in volume. Obviously, volume's a problem when it comes to FX markets because no one's got reliable volume data unless you actually look at some of the futures, FX futures that are traded on various exchanges. That does give you volume data. And there's lots and lots of different patterns that we haven't covered today: wedges, rectangles, pennants. They've all got wonderful names. But in general, if you stick to the rules of, is this a consolidation? Can we define it with a couple of lines and wait for the breakout and trade in the direction of the breakout, then it's something that you may have some joy with. I use these if they're very obvious. I've got one of my analysts is very keen on using these, and I did actually ask her earlier. I said, can you help me out here and get me some some examples of consolidation patterns and things like that. This looks a little bit like a bull flag in the Canadian dollar. Okay, and the breakout was here on the 27th of November. The unfortunate thing we've got here is we've got one of these situations where it's not. We've got that breakout. If you'd have bought that, you'd be onside, and you've never been offside since. But we are struggling at resistance. Look, we've got 140, 114.60 was the high on Monday, and that was a failure just shy of the 5th of November high at 114.68. So we're kind of waiting for the next tick on that one to say that is a that is a bull flag, and that gives us that we've got a target probably somewhere up here. Should we do the target thing now? I actually use a rather nifty piece of I use this Fibonacci extension tool. Let's say, hang on, let me just double check. We need to get this into context. Yeah, I thought so. It was the July low, so what we can call is the start of that move, and we'll plonk that on top of there, and we'll say that the second the breakout was there. We need to see off 1468 clearly, but actually that gives us a measuring objective of 121.50 for dollar CAD if we if and when we can break out above 1468. I've got a rather neat channel going on there as well, which could cause some problems when we get to 115.94. But if you're positioned right and you're using your stops and you're aware of where the resistance levels are, then there's always opportunity to try and stay with that move. It's obviously going to take a while. It's not going to shoot up to 121.50 in a hurry. Well, generally not. You know, it took from July to November. It took that whole period there for the first half of that move to unfold, if you like. So we wouldn't expect it to be sort of going up in a straight line to here, but that is an ultimate target, if you like. When does our channel meet it? Years into the future. Oh no, March. Okay, that's interesting. So that's the they're the trend lines and the things we're keeping an eye on that dollar CAD daily chart at the moment. Have I got anything else that's really juicy that I might want to show you? Let me see. One more thing I think we'll look at, which worked out rather well for us, and I hope it'll work. Let's see if it does. Is Euro sterling. This has been a bit of a mess lately, this one, but we did. Right, I think yeah. Sorry, I'm sorry. As I say, I asked my analyst earlier to my FX analyst to throw a few of these patterns at me, and I think this is what she came up with. I'm not going to find it now, so I'm going to stop talking. I'm afraid I've rather messed it up. Okay. If anybody has any questions on anything that's been discussed and those chart pattern ideas, then I'm sure we'll find a way for you to get in touch with me through Mihail. Thank you very much for listening, and I shall pass you over to the excellent Darren Sinden now, and bid you good day until next week. We'll be here again on Tuesday. Thank you very much, everyone.
Thanks very much, Clive. Michał, if I could have the screen, that would be much appreciated. Thank you. Welcome, everybody. It's quite unusual for me to be going second on the show, but let's kick off with my half of the long and the short of it. Let's just go to the slide. Okay, so I'll just drag that out of the way. All right, there we are. So welcome to the fundamental, the macro part of the program, as it were. We'll start where we always do, with mood of the markets. A bit like the weather, really, a bit gloomy, or certainly the weather in London, and waiting. I'm waiting for the rain to stop. The markets are waiting on some interest rate decisions, principally that of the ECB, although we do have the Bank of England in about 25 minutes time. But not much expected out of the Bank of England meeting. Status quo is the anticipation there. But for Europe, some in the markets are hoping for a further reduction in what were already very low Eurozone interest rates. They're also hoping to hear in the press conference that the ECB will be more vigorous in its buying of asset-backed securities and covered bonds than we've seen to date. And they'll also be hoping to hear further hints about the implementation of full-blown QE in 2015. Whether we do hear any more about that is debatable. We'll have to wait for the actual press conference to see. There were some better than perhaps anticipated PMI numbers, retail PMI numbers in the Eurozone today, but that's perhaps one crumb of comfort in a sea of woes, if I can mix my metaphors there. So let's have a look at some of the things that have caught my attention over the past day or so. A couple of media sound bites. Well, the first is from Goldman Sachs, and it's their view, so we should probably listen to what they've got to say about what's going to happen to euro dollar in 2015. From their report yesterday, we discussed 4 valuation approaches, all of which are rough benchmarks and therefore hardly conclusive. That said, these 4 valuation benchmarks all point to substantial downside for euro dollar, and from here we think that could be at least 10 big figures, which is in line with our 12-month forecast of 115. So that was Goldman's on euro dollar yesterday, looking for a big move down to 115 for euro dollar in 2015. Comment now from UBS on oil. It's hard. Clive talked a lot about oil. It's hard to get away from it. It's the dominant macro factor at the moment. UBS again published a very impressive note on the sector, on the product as well. Their comment was, we project a significantly oversupplied oil market and consequently material lower oil prices in the medium term. And we now forecast prices below $80 for the next 2 years. And in fact, they actually do mention a period of low oil prices, perhaps extending out to 4 years. They also went on to say one characteristic of the oil market and as a whole, they mean here, over the past 4 years has not only been its high level of prices, but its low level of volatility. And this is set to end. We've already seen that to some extent. But it's probably worth pointing out here that trending markets tend not to be volatile. And the longer the trend goes on, the less volatility we tend to see, and we'll talk more about that perhaps a bit later. When we do see volatility is when a trend changes or comes to an end and we enter a counter trend, particularly if that happens very quickly. So what the money thinks, well, this is a comment from SocGen, but it could apply to any number of big banks. US equities may now have peaked for now. European equities with overseas exposure are expected to outperform in 2015 thanks to anticipated ECB QE and a weaker euro for the obvious reasons. And the SocGen comment which took my eye was the one about US equities. Since 1875 we have never seen the S&P rise for 7 calendar years in a row, and so they haven't seen rise. We haven't ever seen the S&P rise for 7 years in a row. So let me just go back to that. And it seems unlikely that we will see that next year. We assume the S&P will finish the year slightly lower as the strengthening, slightly higher, sorry, as the strengthening of the US dollar and the new tightening cycle offset the strong GDP growth already priced in at the start of the year. So if we did see a continuation of the rally in the S&P and the other American markets for next year, it would be unprecedented. History tells us that we shouldn't see a continuation of that. So let's see what January brings, of course what the whole of next year brings, but certainly bear that in mind. 1875, so 140 years plus, we haven't seen an S&P rally rise for 7 years or more. Okay. Right, so on to the meat of today's webinar, if you will, long and short of it, volatility. As ever, we're relatively constrained for time again today, so I won't spend any great time looking at the actual maths behind volatility. There's plenty of background reading to do on that. If you're interested, there are also lots of tools around on the to help us calculate volatility. So if you want to do some exploring or have a look at some of those, please do. But let's crack on. Okay, so the best place to start probably with an understanding of volatility is to look at the definitions. Well, what do we mean when we talk about volatility? Well, we've got 3 definitions here, so a strict dictionary definition, if you will, at the top. Volatility, tending to fluctuate sharply and regularly. We might take issue with the idea of regularly. A statistical measure of the dispersion of returns for a given security or market index. A measure for variation of price of a financial instrument over time. Historic volatility is derived from the time series of past market prices. So volatility, it can be measured historically, and it gives us an idea of what's gone before. We need to think about implied volatility or future volatility if we want to know what's to come, but again we'll come to that in a moment. So causes and reasons for volatility. Well, volatility occurs in the financial markets for many reasons and at many different times, but one of the principal causes is uncertainty about what will happen next, and that typically follows a shock or sea change at the end of a long-standing trend. And there's no real greater example than that, obviously, than what happened post the OPEC meeting on Thanksgiving Day, when for the first time in probably living memory they stepped out of the ring, if you will, and decided not to try and do anything about the price of oil, tried to let it find a natural level. And as I say, those the ramifications of that move are still rippling through the market as we speak. No volatility applies to price movements in either direction. It's often most associated with periods of sharp downward price corrections or negative news. So we do see volatility on the upside as well, and a good example of that would have been back in 2009 when the Fed intervened into the market for the first time after or for a significant time really after the credit crunch, and the market rallied. Particularly equities rallied very hard on the back of that, having been in a substantial downtrend. So you can see a bounce, but normally when people talk about volatility, they're talking about downside moves, things that come from way off in left or right field and change the view of the market, perhaps within a few hours or a few days, and leave people scratching their heads about what's coming next. Volume can often dry up at that point, and prices whipsaw dramatically. So if we look at some examples of what volatility looks like in the market, we've got two charts here, two completely different markets, 10 years apart, well, more than 10 years apart, 12 years apart between the two, and yet the two things look extraordinarily similar. Our left-hand chart is a snapshot of the NASDAQ 100, and I've highlighted there in the red ellipse a peak and fall that constituted the dot-com bubble. Volatility there, massively heightened, probably one of the highest levels we've seen by some measures. And then to the right-hand side, a very similar-looking chart from 2012-2013, which is Greek 10-year bonds, and this is the yield rather than the absolute price. So this is the if you like, the interest rate that Greeks had to borrow pay if they wanted to borrow over that period. You can see a tremendous spiking up and then a fall back down towards some sort of normalised levels as the EU had to and the IMF had to intervene and save Greece. But those are the kind of sea changes we talk about that people associate with volatility, market dislocations, if you will, and that's what we need to be aware of, particularly with our money management and our risk management. So the calculation of volatility, well, as I said, I don't propose to spend any real time talking about the maths of the calculation of volatility. If you're into that sort of thing, there's plenty of information on the internet about that, and if you want to brush up on your calculus, that's a very good place to start. But volatility is a complex statistical calculation that tells us about the distribution of a given move for a financial instrument or market. Those instruments with higher volatilities have a greater likelihood of large price swings, and those with lower volatilities have a lower probability of large price swings. Volatilities are typically expressed as a percentage or ratio, with the former ranging between 0 and 100, although you'll be very unlikely to see either of those outliers, as we'll see later. I think we'd probably be unlikely to see volatility above 80%, and even then that would have to be in the most extreme measures, such as the meltdown during the credit crunch. Okay, so methods of calculation, well, there are many and various, and as with a lot of things that we'll talk about in these seminars, the theory's really been a work in progress for the last 30 or 40 years. Perhaps the best known method for calculating volatility is the Black and Scholes model. This was developed by Fisher, Black and Scholes in the early 1970s, and a chap called Robert Merton went on to develop the theory later on, and Scholes and Merton won the Nobel Prize for economics in 1997. Unfortunately, poor Fisher Black had died before then, so you can't receive a Nobel Prize posthumously. So he got a mention, but the prize just went to Merton and Scholes. Now, Black and Scholes was developed principally as a pricing tool for options. As I say, the study was published in 1973, the same year, if you recall, that Kahneman and Tversky published their piece on prospect theory. So a really important year probably for thinking about the market. The key, I think, to Black and Scholes is that it can be thought of what we would term as a deterministic model that doesn't consider or doesn't anticipate random factors. What's quite ironic about that is that Robert Merton went on to join long-term capital management, which actually at the time, which blew up in 1998, at the time was the biggest hedge fund failure that the market had seen. And the reason that they found themselves in so much trouble was because of one of these anticipated factors, unanticipated factors, a black swan, if you will, which was the Russian crisis of 1998. A certain amount of irony involved in that. One of the other methods that people use is what's called a stochastic model, and that method assumes random outcomes which evolve over time and can be thought of what we would term a probabilistic approach. That is to say that it focuses on the most likely or probable outcome from a wide variety of scenarios. And to put that into some kind of context, that's very similar to the way that modern weather forecasts are done, where you run a wide variety of simulations with varying factors and see what the outcome from the model is, and then if you like, the most probable or most frequently occurring, that's what I'm trying to say, the most frequently occurring result is the one that you will go with. So again, there's massive debate about which is the most appropriate. I think it really just depends on how you view the world, whether you believe that history repeats itself, or whether you believe that there's a complete random walk throughout history. And there are various other methods that are used as well. Monte Carlo simulations are another. But if you want to read out more about that, then please do. And we'd be if you want some pointers in that direction, we'll be happy to try and provide those for you. So what are some common measures of volatility? Well, the one that perhaps that people talk about the most when they discuss volatility is the so-called VIX index, which is the Chicago Board of Exchange Volatility Index, which measures the volatility of options, or the implied volatility, I should say, of options on the constituents of the S&P 500. So it looks at the volatility for put and call options on the 500 leading US equities that make up the S&P 500. So this is an index that for many years people have looked at when trying to measure people's appetite for risk, or people's expectation of what's to come in the market. But from my own point of view, I think the sensitivity of the index has to some extent been masked by QE. Also, its use has been reduced because there have been the emergence of a number of VIX-like volatility index-like exchange trading notes and ETFs have emerged over the last 4 or 5 years. There's also a greater use of swaps in volatility, or variance swaps as they're called, something we might touch on briefly in another webinar. Well, what you can see from the chart to our left is this idea that in a trending market, volatility is relatively light, and here we see the pre-2007 bull run. Yes, we've got some volatility, but broadly speaking, it's nicely contained within a narrow range. A slight spike as the credit crunch begins to bite here in 2007, and then a massive leap in volatility with the failure of Bear Stearns and ultimately Lehman Brothers, and then the Fed intervention over here to the right, and gradually volatility over a relatively short period of time melts away, and then to the right hand side of the chart we see almost a flat line in volatility, because the Fed is in the market. There's one buyer for everything with a QE program. Equities and other markets trend higher, volatility fades away. Because we've finished now with QE as far as the US is concerned. Yes, the Japanese are going to be printing for some time to come, and maybe the EU will join. Perhaps we will see a return to volatility in 2015. We've certainly seen it in the price of oil. We did see it briefly in October this year when we had that mini crash, although we've obviously rallied sharply back from there. But do expect perhaps to see more volatility as next year unfolds. So I thought it'd be instructive to have a look at volatility in FX and what that might look like on a chart. So here is a picture, a snapshot, if you will, of the volatility over the prior 10 weeks in some pairs and crosses. Quite interesting to see how skewed the chart is, though, by one currency, which is one currency pair rather, which is dollar ruble, and obviously, though the ruble had weakened sharply against the dollar since the early spring, since March-April time, it had an absolute nightmare on Monday. We touched on that one, didn't we, on Tuesday when we talked about the 9% fall in dollar ruble. There's been a bit more volatility in the currency again this morning as well. Mr. Putin was making his State of the Nation address in Russia this morning, and I noticed before I came on air that it was jumping around like a good one, shall we say. So skewed here, obviously, towards the ruble, but plenty of volatility elsewhere. The prior candidate for the most volatile pair had been dollar yen. There's also been some significant moves recently in sterling kiwi, sterling cad, and I also noted that dollar Danish kroner was up there, though I have to say, I slightly question that figure, and I'm not going back and checking that just to be sure. But it gives you an idea of what the most volatile pairs and crosses are at the moment. In terms of things that are relatively staid, Aussie Swiss franc down here, and not unsurprisingly Euro Swiss franc, which is sort of bobbling around 120 and has been for some time, but the Swiss central bank is defending that level, so it's not a particular big mover. Of course, that would change if that 120 level were to give way. So the collapse of the ruble versus the dollar post the OPEC meeting has skewed the chart somewhat, but it is a perfect example, i.e. that move, of how volatility can manifest itself in a market and do it very quickly. Just an observation, a bon mot from JP Morgan on volatility. Their FX guys talked about volatility in the foreign exchange market reaching the highest point in 10 months. That was as of the 20th of November. I suspect that that figure would have gone up more since the moves in oil and the ruble on Monday. So really, to finish with, just to leave you with a question really for you to consider perhaps over the weekend: does volatility represent an obstacle or an opportunity? I think the honest answer is that it represents both. It is both an opportunity for traders, but it does present an obstacle to profitable trading, because the larger price movements can equate to higher returns, but it can just as easily mean larger losses. What we need to think about in all of this is sound risk and money management. The use of stop losses can help to mitigate unexpected losses. That's why we suggest people trade with a stop loss in the first place, because a disciplined money management stop will hopefully limit your losses and maybe a bit of slippage, but they should be in the ballpark. But of course, we don't tend to get gapping in FX, and so that's good news for you. But scaling your trade sizes down in uncertain times, when you're unclear about what is going to be the next direction in the market, that tends to make sense. And perhaps scaling into and out of positions, seems prudent. Don't need to have all of your money in the market at any one time. If you want to have a position in a volatile market, dip a toe by all means, but perhaps consider splitting your usual trading unit up into 2 or 3. Scale into the position. If it starts to go your way, then why not? You can add to it, move your stops up as soon as you can, and when you're scaling out, don't necessarily come out all at once. Perhaps take it off. If you put 3 positions on, then perhaps take them off 1 at a time as well. One final thought to take away with you for the weekend is, as with any standard distribution, volatility does smooth out over time. So although we looked at some charts there, with sharp peaks in, those peaks aren't going to go away, but obviously as we have a larger time frame, more units, shall we say, in our set of set of distributions, the actual average volatility is going to flatten out over time, and we'll get back to that traditional looking bell curve shape, if you indeed believe that Gaussian distributions are correct for markets. We'll probably have a debate about that and the other types of distribution again at another stage, perhaps next year. But I'll leave you with that. Do be careful, as I say, these are volatile markets. If the ECB says something unexpected this afternoon, we could certainly see a bit more volatility in the euro and other currencies trading around the euro. So we finished a little bit early today, but I don't think that's necessarily a bad thing. The Bank of England interest rate coming up at 12 o'clock, and obviously the ECB at 1:45. Watch those with interest. Good luck with your trading. Any questions, of course, please address those to Misha and Clive, and I'll be very happy to try and answer those for you as soon as we can. Thanks very much for joining us, and I look forward to speaking to you all on Tuesday. Misha, I don't know if you've got any closing comments, but I'll hand the floor back to you.
Thank you very much, Darren. We'll see you again next week. The next webinar will be at 11 o'clock on Tuesday. Thank you very much. See you soon. Bye-bye.